All right, so here's the advanced Elliott wave. It's going to go, if you were in the last presentation, this one's just going to delve a little further into really the trading techniques. All right, channeling, which is one of the best ways to determine trend. Okay, right, breaking of channels happen before breaking of moving averages. It's really your first indication that the trend is changing. Just as an example. Okay, so here's the risk disclaimer. And at this point, I think everybody has read it. Seen it about 1 million times today, right? Okay, so there's going to be a lot of text, okay, and I'm not going to read all of it. I'm just going to go over some of it. The reason is when you see these presentations later online, you're going to want this as a guide, okay, to follow all the specific rules. Really the three most important rules and the only rules that you really need to know, memorize for Elliott are that, right, wave 2 can't go below wave 1, wave 4 can't go below wave 3, the beginning of wave 3, and wave 3 is never the shortest wave. And that's really, those are the non-breakables. But here we have a couple more detailed rules that you're going to want to keep in mind, right? That wave 1 must be an impulse or leading net, and what that means is, for example, that wave 1 can't be 3 waves, okay? Wave 2 cannot be a triangle, for example. So if you see a triangle, you know that something else is going on, like a larger correction. Wave 3 cannot be a diagonal, it has to be an impulse, right? It's got to be a faster moving pattern. Okay, and then there are guidelines, right? Rules cannot be broken. Guidelines are tendencies, right? There's so much to Elliott, and these aren't even all the guidelines, but these are the major ones, right? Wave 2 is usually sharp. In other words, it's usually a zigzag. And that makes sense, because think about the position of where wave 2 is. It's after a major low, or it doesn't have to be a major low, because it happens on any time frame, but think of the psychology that attends to a wave 2 correction. You have this rally or decline from a significant high or a significant low that is the beginning of a new trend. At this point, the trend's probably so ingrained in most minds that everyone thinks when it goes the other way that it's just a temporary setback. I'll use an example right now of the U.S. stock market. The rally from the low on a larger degree, primary degree, is probably a second wave. Could be a B wave, whatever. Bottom line is it's a second wave, and any weakness is met with news headlines of, setback, more or less, right? Everyone believes in this rally. So wave 2 is usually sharp because it almost takes out wave 1 and continues whatever was happening. Wave 4, meanwhile, is usually more shallow because it follows a very strong move where the market's that much stronger, and the psychological forces that are going to make a correction is probably going to be more sideways than sharp. Okay, and then we have some of the measurements in here, likely retracements for wave 2, 50 to 62%. Targets for wave 5. We'll get into some of this with some real-life examples, but wave 5 tends to equal wave 1. Okay, it can be related to wave 1 by a Fibonacci measurement, which is 161.8 or 61.8. And as I mentioned in the last presentation, someone says, well, what's an extension really mean? Extension is simply one of the waves a lot of times 3, 5, or sometimes both, is going to be at least 162%, or 161.8, okay, of the shortest wave. And then this is one that you would see even if without an understanding of Elliott, but it helps to understand why this happens. Wave 5 usually has a lesser slope than wave 3, right? The divergence, a slower rate of change. Channeling. This is the best, most useful part of Elliott, I think, is channeling. And it's not just impulses, but also corrections. But channeling impulses, once you have 3 waves up, okay, so you're in a sideways corrective pattern, and you think wave 4 is underway. Okay, so at this point, you can draw a line from 1 to 3. You take a line parallel to that and extend it from the bottom of 2. So you have a temporary line, and then once price gets close to that line, you look for signs of a bottom. This is a recent example. This is the euro-dollar decline from the November high. I think this is probably on Thursday, so or April 26th, it says on that, so I don't know what day that was. That might have been Monday. But you can see, looking for the 4th wave, that's where it ended. All right, and yeah, this is very easy in retrospect, I understand that. But this was also done at the time. I remember, okay, if we go back in the archives of daily effects, we can find this temporary channel line and talking about wave 4 may be complete because we are testing the Elliott channel. That's what I call it, Elliott channel. This is a much longer term example, obviously, but this is the U.S. stock market from the 1930s low, right? We have the 5 waves, and you can notice this is clearly log scale, but we had the 1-3 line, and the 4th wave, the pinpointed low, the 70s low. And then within wave 5, you had the 1-3, okay, the 2000 high. You were able to draw a line at that point and extend a channel from the wave 2 low, and that pinpointed the low in after the tech bubble burst, and we ended up making a new high. That's why I count that from the bottom of wave 4 as a 5-wave rally. Truncation happens when the 5th wave fails to make a new price extreme. He fails to move beyond the end of wave 3, whether that's a new high or a new low. This tends to happen if you have an exceptionally strong 3rd wave. In other words, you've moved many multiples of wave 1 in percentage terms. So this has happened, I believe, in the British pound. After we ran up all the way to 210, we had a decline, okay, which was pretty quick, going from 210 to the low 190s, okay, from November of 07 down to January 08. All right, that's a nearly 2,000 pip move in a relatively short amount of time, several months. Okay, you can see wave 5 did not meet the end of wave 3 on an extreme basis. It did actually on a closing daily basis, but as far as that long wick for the end of 3, it did not reach the low. And there was yet another one in the correction there. Wave C did not reach the end of wave A. The thing with truncations is, though, that you don't know necessarily, have an idea that it's happened until you may have retraced the entire move. Okay, I don't like to treat things as a truncation. Someone was asking me in the last presentation, we may have made a 5-wave decline in the dollar-yen from the 70s. Does that mean that the decline was truncated? I was explaining I was bearish still, long term, because we had yet to break the 1995 low. Well, someone said that could be a truncation. Well, it could be, but the weight of evidence wouldn't favor it, and truncations are rare. I like the market to prove it's a truncation before I assume so. Zigzag rules. Oh, real quick. Why truncations are important, even if you recognize them after the fact, is you know then when to count your next count from. In other words, we know that wave 3 starts from here in the pound, okay, that it didn't start from here. Okay, zigzag rules. Wave A must be an impulse or leading diagonal, otherwise it must be a motive wave, right? Can't be 3 waves. If it's 3 waves, then you probably have a flat. Wave B can only be a correction, can be a triangle, can be a zigzag itself. It's usually a triangle or a flat in my experience. You cannot have both waves A and C be diagonals either. That does not happen. If that happens, then you probably have the beginning of a larger correction. And think about the psychology that it tends to a zigzag, right? You have a sharp rally off of following an impulsive move, either up or down. So let's say you have a sharp rally following a 5-wave decline, and it's impulsive. So you know a larger correction started. The wave B does not retrace a whole lot of wave A, usually a third, maybe half. And the reason is because the impulse off the low provides enough change in psychology that we're not going to go test the lows again, unlike happens in a flat. Okay. Guidelines. Wave B most likely a third to a half. I have 2/3 there because it can happen, but it doesn't happen nearly as often as a half or a third in my experience. Wave C tends to be equal to wave A or can extend. Rarely do I find that it's 61.8, but if you do end shy of being equal and you have reversed and seen some signs of continuation of the larger trend, then check to see if it was related by a Fibonacci ratio, such as 61.8, because then that might have been the end. And again, if wave C is much longer, say wave C is all of a sudden 2 times longer than wave A, you're probably not in a correction anymore. You're probably in the beginning of a larger impulse. At that point, you would then look for a wave 4 correction, right? An example of a zigzag. Okay, this was the first wave of the larger triangle, right? But triangles tend to have zigzags within them, and you can see the ABC formation. I didn't do measurements, but it would not surprise me if wave C was about 61.8% of wave A in this instance. And you can see also the way to channel. Channeling corrections is different than channeling impulses, but once you are certain that you're in wave C, okay, then you can put a line connecting the beginning of A, the end of B, and then make your temporary channel extended off of the top of A, and that tends to pinpoint the end of C. Okay, and it did, in this case, it did a pretty good job. You can look at C as well. Within wave C, you can see that that's a diagonal itself. Okay, you have 3-wave movements, 5 3-wave movements, right? 1, 2, 3 in the middle, and it overlaps a lot. Oh, I did do the measurement. Never mind. So, the measurement, you can see, this is extremely important too. This is on, I believe, arithmetic scale, and this is on log scale. You can see on arithmetic scale, the channel method pinpointed the high. On log scale, percentage scale, the measuring of 61.8 pinpointed the high. This is important. You need to do both of these when looking at longer-term charts because they're sometimes it conforms to percentage movements and sometimes it'll be in pip movements. More likely than not, measurements will be much better in log scale because you are measuring percentage changes, right? A move from 80 to 90 is much different than a move from 140 to 150. Pound yen weekly, this is the same period, obviously, from the 95 low or yen high, and we get the same thing here. This is the euro dollar, more or less right now, but you can see this is I believe this is a weekly chart, but we have ABC down, ABC up. So if we were to, where are we now right now in the wave structure? We're in probably larger wave C down of an expanded flat, right? This would be then larger wave A ended at the 2000 low, larger wave B ended at the 2008 low. Wave C, larger wave C is underway now. We made 1, 2, we are now in some sort of third wave. My expectations are for it to continue much lower and eventually possibly break the 82.25 level in a number of years. It's not going to happen tomorrow unless Europe blows up or something. I don't know. Okay, Kiwi monthly arithmetic chart. You can see the channeling technique doing from the very top of A, and that's important. You see how this wouldn't be considered a normal channel by a lot of technicians, because you can see that it stopped. A lot of price is outside of the channel here, but you start from the very beginning of the move. Okay? That's important. If this channel was different, if the line started here, the slope would be more increased negative slope, and this line would not have come close, right? This line would be somewhere over here. Okay, flats. Wave A, usually a flat itself, right? It goes 3, 3, 3, 3, 5, or it can be a triangle, 3, 5, 5. The wave C must be an impulse or diagonal. A lot of people make too much about, is it a flat or a complex correction, which you have, say, 3, 3, 3. If you were in the last presentation, I was showing the pound dollar currently, in which the rally from 147.80 can be subdivided into 3, 3, 3. It looks like a flat, right? But technically it's not. But it doesn't matter. They're the same thing. It's the end of a correction. Bottom line is, end of a correction, you're looking to turn bearish. In that instance, sorry. Okay, wave A, usually a zigzag of sorts. Okay, wave A rarely like a expanding triangle, which what I mean by that is, I should say diagonal, as in leading diagonal. Wave B, usually zigzags, usually a series of zigzags for the first two. Bottom line is that it's not an impulse. Trading flats is somewhat dangerous because it tends to break, you tend to break the bottom of the wave A, you tend to go below. These are the kind of corrections that end up stopping everybody out. But the kicker, what really sets it off, is that wave C is definitely an impulse, okay? And a lot of times it happens where wave C in an expanded flat looks like the beginning of a larger decline. In this case, from the 2004 high, you had a decline of 5 waves from a major high. At the time, reasonable technician would think that a major top was in place, but we ended up exceeding it and going on to 160. So you have a careful examination of what happened. This would be then an expanded flat, right? It's difficult to count this B wave as an impulse because if you think about it, you have here 1, 2, 3, 4, 5 up there, but then you don't. But then you have this, so you have A, B, C. You don't have a big 4 or 5, right? Okay, alternation is very useful in that you understand what not to expect. So if you know you're in some sort of third wave, you usually know when you're in a third wave because they're very strong moves. For example, the recent euro decline, right, from I believe it was the February high or January high, was a third wave. And you knew to expect probably a shallower retracement rather than a deep one. So that holds that if wave 2 is sharp, or a zigzag, right, then wave 4 will probably be a flat or a triangle. It's probably not going to be a zigzag. It's not a rule, but it's a guideline. It often holds. And as I mentioned earlier, describing the psychology of the move, it makes sense because if you have a very strong trend, right, that trend is deemed even stronger when the ensuing correction is flatter rather than sharp and against it. And this is an example. I believe this is the pound yen, I think. But you can see the 5-wave decline from the top, right? You have a fairly sharp rally. And then you have the 4th wave decline is clearly going to be flatter than the second one, but you would expect that at that point. So from a trading standpoint, you may have some sort of sentiment extreme and very oversold condition down here at 3, but you're not going to buy, out of the money, deep out of the money calls or something, or you're not going to establish longer term bullish positions because you are fairly certain the probability favors a flatter correction rather than a sharp one. All right, so getting into Fibonacci, common Fibonacci relationships. These are useful to have just because, knowing when to measure. A lot of people will use Fibonacci, but they may not be using it in the context of the wave principle, so that they may not be measuring from the correct places. Right? A lot of people measure from a major high or low to the next major high or low, which sometimes, probably most of the time, is correct. But a lot of times, or other times, you may have a 3rd wave measurement that you're looking for the end of the 4th wave, but they're measuring from the top of 1 down to the bottom of 3. You're not going to find any meaningful relationship, or it's likely you won't, I should say. Never say never, of course. But these are common relationships. And the most important ones are the ones that relate to each other within an impulse or a correction. What I mean by that is how waves 1, 3, and 5 relate to each other, rather than just how wave 4 relates to 3. But how 1, 3, and 5 relate to each other and how A and C relate to each other. Okay, the specific setups for Elliott. Obviously, you can't trade every single price movement. For one, it's unreasonable to expect, and 2, you introduce the potential for a lot more error. You can screw up basically a lot more, right? It's hard enough, so you might as well find the best times to get in and get out than try and trade every single little move. But these are what the 3 I like to follow and I like to look for, and that is 1-2 base. In other words, you're looking for a larger basing pattern. An example I can give right now of that is the dollar CAD. We had a strong rally off the low. We had a strong decline, right? The strong decline is a second wave, the way I'm looking at it, my interpretation. Again, it's a strong decline. It retraced, I think, more than 2/3 of the recent rally from the low. But second waves usually are sharp, so you know to expect that. It's not a surprise. But that gives you a low-risk entry point because you're very close to the beginning of the what you were deemed the origin of wave 1. It could also be ABC, but bottom line, you're expecting higher prices. The second one is an ending diagonal reversal. Also, could be thought of as the end of a wedge pattern, right? And this happens at the end of larger moves for the most part. And then the last one is finding basically the last correction in a trending market, finding that wave 4 end point. Okay, and remember I talked about the channeling. That's the best way to do that. Okay, so 3rd waves, why do we want them? Because usually has the most potential for the largest move in the shortest amount of time. And that can be good or it can be terrible if you're on the wrong side. All right. What are you doing? Very simple. You're looking for a 5-wave move from a significant low or high. Now, one trick to do this is scan the markets, because you don't want to stare at every single chart on every single time frame to find a 5-wave movement from some high or low. Is just throw up a 20-day rate of change or something, or if you're longer term, maybe a 13-week rate of change, or if you're even longer term, a 12-month rate of change, and scan to see the historical rate of change history and see how it tends to make significant highs or lows. For example, recently I don't know if I had this chart up, but on the Aussie dollar, rate of change has recently exceeded and then declined from a historical record. So on the 12-month, previous instances of doing that indicates downside for at least several months and usually years. So have you made a sentiment extreme, a rate of change extreme on a longer term chart? Okay, so this is an example of the 160 decline, from 160 I should say. Okay, this is the 60-minute price action at that time. And you can see even on the very small hourly chart, you have the channeling technique that pinpointed the second wave retracement and also happened to be the 61.8 retracement almost to the pip, right? And that's where we made the second wave high or the secondary top, and then the euro tanked for months. Another thing before we go on, this chart, remember one of the rules of Elliott is that wave 4 and wave 3 don't overlap, right? Clearly they overlap here, but it says in Elliott's work, he wrote that it does not overlap for a significant amount of time. I take that to mean daily closes. In this case, which is an hourly chart, you have overlap for several hours. In the grand scheme of things, I don't view that to be significant. And his word was for a significant amount of time. So that's how I look at it. And if you were to not have that, you'd have a clear 5-wave decline. If you were to plot it on closing prices, it looks like a 5-wave decline that does not overlap at all. And it is fairly sharp. The slope, you can see it is fairly sharp. Okay. Ending diagonal reversals. Remember, diagonal is a wedge. Usually occurs at the end of a larger move. What you want to do is just like you would, make a triangle, but it's a triangle tilted, right? You draw your lines off of the tops of waves 1 and 3, and then 2 and 4. Wave 5 usually ends after rallying above the 1-3 line and then coming back below it. Once it comes below it, you can trade against the high. This is the euro yen back in, this is I think 07, in March of 07. But you can see the tops of 1 and 3. We go above 5 for a little bit and then tank 2 and 4. Okay. Yeah. Mm-hmm. Oh no, just a simple rate of change indicator is just you're just taking period. Say you have a 20-day rate of change, so you would take the indicator is just today's closing price divided by the closing price 20 days ago. So just how much we've moved, basically. I like to look at rate of change. Momentum will show you the same thing, except it's subtraction rather than division. But I like to look at rate of change because if you're going back and forth between shorter term and longer term charts, longer term you want to look at rate of change differences rather than absolute because, as I mentioned, a movement of 1,000 pips on from 80 to 90 is much more significant than a movement of 1,000 pips from 140 to 150, right? So you want to know the historical how rate of change affects price afterwards, after how price reacts after a rate of change has been at an extreme level, high or low. You'll find it on any charting package. It's one of the most basic indicators there is. And usually the simple ones are usually the best ones, right? On that note, I know this has nothing to do with Elliott, but I like to look at the pure price. There are so many indicators out there. That alone tells you that most of them don't work very well. Otherwise, they would have stopped a long time ago. But they kept making them, so. All right. Again, okay, the third setup, really looking for the fourth wave, the end of the fourth wave. You're looking for the last correction So you've got you would have 3 waves up at this point, a really strong third wave, right? You've been trading sideways for several, let's say we're looking at daily chart for several weeks. And what you do is you look for the intersection of the channel line and the, but roughly maybe a third retracement. And I didn't have it written down, but the third thing to look for is the former fourth wave of 1 less degree. Basically, you're looking for a former congestion to hold as congestion again, or as a top or low. So you can see here, this is the euro from, again, the November 08 high. Right, we have 1, 2, January high. We fall very hard in 3. We start to trade sideways, so we're going to look for the end of the fourth. By doing the parallel channeling technique, we find, that it holds, more or less on a closing basis, right? And it also holds the fourth of 1 less degree right here, right? That congestion area. Okay, these are the most common ratios. I know I had earlier, but these are just the most common, the ones that you want to pay attention to the most. That is wave 2 is deep, it's sharp, right? Usually retraces at least 2/3 of the wave 1 rally. Wave 3 tends to be, at least 161.8%. Wave 4, about 1/3 of the third wave rally or decline. Wave 5 tends to equal wave 1. Sometimes it's related by a Fibonacci ratio, whether that's 61.8 or 161.8. Wave B, depending on what it is, okay, if it's a zigzag, right, it's going to be closer to 1/3 or 1/2. But if it's an expanded flat, sometimes it'll be as much as 138.2%. And then wave C, 1 or 161.8. In rare cases, 61.8, remember. This is just an example of these measurements in action. This is the decline from the 04 high at 136.60, remember, in the euro, and we fell to the 05 low roughly a year later. And you can see wave 1 we had was 936 pips, okay. Wave 2 was about 78.6% of 936. Wave 3, the extension line, extended a bit beyond 161.8. Okay. Wave 4, do not have it here, but it was about 1/3 of the entire decline of 3. And finally, wave 5 was 950 pips, which is pretty darn close to 936 pips. Right? Those were equal. This is just obviously an example that was hand-picked, right? Because I wasn't going to show you an example where it didn't work. But no, to be honest, it gives you a good idea where to expect support and resistance. So, if we were falling off the cliff here, someone might have said to you, "Holy cow, the euro's, going to go to parity at this point." Well, you say, "Well, it might, but." Jamie Setley told me that wave 5 equals wave 1 sometimes. And so you'll look at that and say, we've moved the same amount as we moved in wave 1 in the same structure. So there's potential for a reversal. Okay, so let's look at some forecasts with Elliott in the immediate future and beyond. This is the dollar yen. If you were in the last presentation, you saw that we had estimated that wave 4, right, ended in 2007 as a triangle. We've had a decline that's pretty choppy and definitely not an impulse, but it very well may be a leading diagonal. Remember, you can have leading diagonals, also ending diagonals. It's kind of a major overlap, not extremely discernible as an impulse. So levels that we'd be looking to return to a short position may not be until 109 or even 115. And I say that because second waves, again, are usually sharp, right? And especially falling leading diagonals. And then this is the daily chart. This is how I've treated the dollar yen for a while. We had the three-wave rally off the low. So we are in some sort of correction, but the correction can last for a long time, right? We had a three-wave decline, and I think we're heading higher in the second of the three-wave rallies, okay? Now, if we were to measure objectives for this, we may have a stopping point near 97, because that's where the first three-wave, or the second three-wave rally equals the first three-wave rally, and then we might, hit the, so you're going to look for 97, and then you're going to look for the channel line. Depending on how the rally progresses, the channel line, could be anywhere from 100 in July to, more like 98 or so in the end of this month. But here's the channel that we made, right? Connecting the bottom of the two, extending from the top. So we have an idea of where we want to place an objective. We might not know when it's going to get there, but we can watch the chart and say when it hits the channel line, it's a good time to get out. So then to review the dollar-yen, we have very long-term, probably heading lower. It's talking years, though. Short-term, as in weeks, we're looking for additional strength towards 97 and parity. Yeah. Right, that's a good question. The question is, if there's going to be a correction in the stock market soon, then would people run to safety and buy the yen? They might, but there's a ton of things change all the time, right? Nothing stays the same. The yen's been a safe haven currency because it's a low yielder, and it tends to benefit when risk is being taken off as it's borrowed, right? And then they have to cover their positions. But things can change. I can envision a situation where the stock market tanks and the dollar-yen soars. It sounds crazy now, but it may very well happen, and think about why. You have a debt-to-GDP ratio that's massive in Japan. And what's the story that's taking hold in the global marketplace right now? It's sovereign debt problems. Something like that could afflict Japan and change the whole dynamic of what's going on. So everyone expects the yen to start gaining just because the stock market may weaken, but the marketplace may have changed. You're not going to know until it does, but I can definitely envision a scenario where that would happen. And that's why it's important to look at each market separately to see what patterns going on in that own market. And you may have an idea of when market dynamics are going to change, such as this. I'm not saying that's going to happen. I'm just saying it's possible. Therefore, I'm sticking with this count because I see it in the dollar-yen chart. I'm not going to change it just because equities are significantly overbought,
Given your use of the bids to measure...
Yeah.
What's your opinion about these harmonics?
Is cycles and whatnot?
No, harmonic trading with the BAT and all the patterns.
Well, harmonics, are you referring to like cyclical?
Patterns and BAT patterns.
Well, I've never studied Gartley or anything, so I don't know anything about his work, to tell you the truth. I've studied some cycles, but I guess I don't find them to be reliable enough to rely on. But I haven't gone through and looked at Gartley's work or cycle analysis, to be honest. Okay, the euro. Here's the euro dollar. Monthly chart, I believe, monthly bars. And we had a three-wave decline, a three-wave rally. This is probably waves A and B of an expanded flat. The ultimate target wouldn't be until below 82. Okay? We do have potential support maybe later this year at 114.36, 115 area, which happens to be just below the 05 low, and also is the 100% extension I believe in log, in percentage terms, of the move from 160.40 down to 123. Okay? So I have these lines here. Remember, even though I'm assuming right now that this is an impulsive decline from the top and that it's going to extend into 5 waves. But I want to have that line there just in case that is also waves A and B of maybe some ongoing multi-decade correction, because if we stop and reverse at the channel line on the bottom that I have, then the probability increases that something else is going on. So, you always got to look over your shoulder and have an idea of what may change your forecast, what makes you wrong, and when it does change, you have to change with it. Well, a 161.8 extension would place it at 91.40. Okay, how long it's going to take. Time is important. It could fall off a cliff in the next several months, or it could trade sideways and correct higher and then fall off a cliff. That's not the point. The point is that there's the potential for a massive decline if this count's correct, because being in a third wave, we know, is exceptionally strong. And so if we get the chance, to be short, such as this morning, I talked about the opening of the euro in Asia last night, and we reversed at the Asian Open. It's the first day of the month, the first day of the week. It's a wonderful risk point to establish a position against. Use that 133.60 as a stop level, because if you go above it, you know that you're probably going much higher, all right, because the first day of the month, first day of the week thing has been violated, but you're giving yourself a chance to participate in what may be a significant 3-wave decline. All right. This is getting a little closer to targets, as you're talking about. This is a daily chart, but you see I'm treating this as waves 1 and 2 up. And remember, wave 2 is usually sharp. This hardly qualifies as sharp. It didn't even make it back all the way to the former 4th wave. But if this is indeed the beginning of a big-time impulse that's going to take the euro that much lower, it's hard to envision it, but if it's going to take the euro that much lower to parity and below, then corrections are going to be shallow along the way. It tells you how much weaker that market really is. All right? Okay, and I had to put this up again. There it is. No. So there's that. That's my book. It's got some Elliott stuff in it, obviously, including those setups and everything, covered in a little more detail. That is included in there. And so you wouldn't have any questions. And everyone's probably tired, wanting to go and forget about this stuff for a little bit. Sure. The flats. Okay, well, yeah. And obviously, all this stuff, including the videos, everything's going to be posted online. Don't know where yet, but sure you'll get an email about it, obviously. Flat. Okay, so flat rules. Yes, the question was just explain more about flats. Well, it is, just the way it looks, is like it sounds. If traditional technicians would probably look at it more as a rectangle, right? Targets? Oh, chart. Well, that's a triangle, so I don't have any real flats here. Well, this is a flat, as wave 2 here, okay? What I've labeled as wave 2. Not that second wave, probably, but the after 5, what's larger 2? So that would be here, okay? A, B, C. You see, wave B retraced most of wave A, right? Almost made a new low. So you're going to have what appears to be just a kind of a box formation. But wave C is going to usually be sharp because it's going to end the pattern, but it's also going to convince a lot of people that there's been a breakout to the upside, and they're going to end up getting in at the worst possible time. That C wave ended on April 12th. That was the gap open on a Monday also, which was following Greek aid plan, if I remember correctly. So that's what completed that flat, right? And everyone was convinced that we were probably going back to 140. Right. Well, the best thing to do is the channeling, right? Connect the bottoms of wave 1 and 3 here, and then extend it from wave 2, and that's the best way. A lot of people place too much emphasis on retracements. The most important relationships, Fibonacci relationships in a market, are the relationships between the waves of the impulse or the correction. In other words, how waves 1, 3, and 5 relate to each other. Not how waves 2 relates to 1 or how 4 relates to 3. All right? The most important relationship, as I said, are those ones that relate in the same direction. Waves 4 are the best with the channel. It's the best way to look for completion of the wave 4. Yeah.
Are there any software programs that are doing a good job with this?
There are software programs. I don't know if they do a good job though, because they're not. I don't know how popular they are, to be honest. But to have a program that's going to spit it out, and it's just not supposed to be that easy. Which is probably why it doesn't work. I mean, there's always multiple counts. There's always multiple counts. Anything can really happen, right? You just have to figure out what's probably going to happen and align yourself with that situation. For example, right now in the euro, we could be, let's look at this right here. In the euro, we could have maybe a rally that goes up to above 150, 150. But it's probably not going to happen because the decline that we had is sharp and impulsive, right? I don't know how this would be labeled. And there's also other elements such as sentiment that you want to introduce to your analysis with Elliott, because you want to see when extremes in sentiment occur, which tend to be in the third and fifth waves. Okay, B waves have sentiment extremes too, but none of that is taken into account with a pure mechanical system. I am sure that there are very bright, intelligent people working on this stuff somewhere, and maybe they haven't shared it with anyone. I don't know, but I don't know of any technical computerized program for Elliott that I would recommend. So, yeah, go ahead. Why couldn't it be wave 1 and a 5? Well, this is another reason we have. Look at it. There could be a lot of stuff, but we had from declining from the 04 high, we had a 5-wave decline, which completed an expanded flat. We also have a perfect channel as it relates in corrections. Remember, in channels, the beginning of the correction in the B wave, and then you extend a parallel. And then that pinpoints the end of the rally. The rally ended there. Therefore, it's probably a correction because impulses don't channel that way, right? Channeling is the most important, I think, really overlooked part of Elliott. It shows you where to start your channel lines and helps you understand, what's probably going to happen in the future. In this case, I'm saying it's probably going to be an impulse to the downside that retraces the entire rally because the rally was a correction, right? As suggested by the way it channeled, right? I'm sorry? You mean wave we're in now, the rally now? All right, it's a wave 2 rally. Wave 2 rallies usually are very sharp, right? In fact, we haven't even consumed as much time in wave 2 as we consumed in all of wave 1. That's not going to be until July. So if I were, I might be looking for a top in equities in July if we continue to go higher. Well, I mean, just in July. Well, time wouldn't matter. I mean, it's just in time, whether it's weeks or days or months or whatever. The decline from, and you're talking about the Dow, the decline from the 2007 high to the 09 low took whatever it was. I mean, that's what, 12, 15, what was it, 17 months? So we haven't spent 17 months since March of 09 yet. No. We went from an extreme high. It couldn't be a third wave. Let's look at the Dow chart I have here. What is that? No. Here's the Dow chart, right? Wave 5 ended a large degree, cycle wave 5 probably, ended way up here. This first decline is wave 1. This rally and now to where we are currently is wave 2. You see? 1, 2. This is a quarterly scale, or a monthly scale, so it's a big chart. But no, that's 1 and 2 in my estimation. Yeah. Right, but again, this is a monthly chart, so we could trade back and forth for years, I mean, this isn't like a hourly chart, Right, I mean, I'm just saying from a very long-term perspective. I mean, this goes back to the 1800s, this chart. So, yeah, this, again, it could happen tomorrow, but probably not going to happen tomorrow. The Euro chart, the one, this one, or, right, this one? Okay. I'm sorry? Mm-hmm. Well, wait, okay, so if you want to enter after wave 1, you're looking for a 3-wave correction of some sort. The best way to do it, and I mentioned this here, is to look for, say on an hourly chart, this is an hourly chart, you use the channeling technique with corrections, which is connect a line from here, right, to, here, or it would be here, roughly the same, and then extend it from the high. Corrections tend to channel just in different ways than impulses do, right? And combined with the fact that it reversed and met resistance at the 61.8% of the prior decline, also combined with the fact that it was former resistance, which was also a former gap. I mean, this is like just screams resistance, right? So all that you have in your favor. So I mean, is there one way where you say, if this happens and this happens, then I go short? I don't work that way as far as my trading, because it's not all automated. But I'm looking for tendencies. Did the rally have a tendency to fit in a channel? And if it did, what did the price action look like at the top of the channel? And maybe it's a good time to go short. Yeah, just not 100.0001. Right, exactly. If you do that, then you're still in the prior trend. No, well, you'd have to abandon and figure out what's going on, because at that point you might be, you don't know where the trend line is, No, I mean, they're not going to. I mean, they're usually sharp, but it's pretty common that 2/3, you'd be surprised. Well, ideally, you'd want to be able to catch the third wave because it's usually the longest, and it's usually the biggest move. That's the best. If you can do that, that's the best. Entering in wave 2 is the best, but it's not always doable, obviously. I mean, you can't do it every time. But yeah, that would be the best, obviously. And from a very long-term perspective, the Dow chart that I've been showing, we might be at wave 2. We might be, we might be at wave 2 now, now or in the next several months. So it's just a very large degree trend, though. We have a question back here, yeah.
On this chart here, are you using Elliott wave on the RSI, or are you using something else than RSI?
No, that's just RSI. I have trend lines on it. Something I'll talk about tomorrow, but check this out. You see, whenever you've made major peak in RSI, okay, this 1929 peak in RSI, we didn't reach that level again at price level for decades, okay, and then we had a peak in RSI in the 50s, but we didn't make the price high until the 60s. But again, we didn't reach back to that prior high for decades. Okay, we just had a peak in RSI in the late 90s, and we just had the second peak or the divergence similar to the 50s, 60s, right, in the '08 high. So going on what's happened when we had peaks and divergences in RSI on a monthly basis, I don't think we're going to make it back to the 2008 equity high for several decades, right? That chart is the same. I'm going to talk about that chart tomorrow too. John Kickleder and I are doing a presentation on forecasts and opportunities for the rest of the year and beyond. So, all right. Yeah. That is tomorrow at 1:30. Okay. All right, everyone. Awesome. Have a good, fun evening, and I'll see you tomorrow.